Hey, Sip&Talkers, welcome back. So I opened my stocks app this morning, just checking yesterday's close,
Yeah.
and bam, that whole block of AI stocks just red hot again, like seriously exploding.
Tell me about it.
I hadn't even finished my coffee and boom, billions added to the market cap. Feels like it's just going to keep climbing today. I gotta say, thank goodness for those stock picks.
Mm.
Do you ever think the market's just caught this disease of never falling?
Well, that's the world now, isn't it? AI wakes up earlier than people do.
It really does.
Every time one of the tech giants makes a move, the whole market just reacts, zaps it, like you said. Luckily, mostly in a good way recently.
Totally. NVIDIA, Amazon, Tesla. It seems like every single day there are these like multi-billion-dollar deals happening.
Tens of billions, yeah.
Does it feel less like investing and more like, I don't know, tracking earthquakes in the tech world?
It really does. So, okay, today let's try and map this out. We're going to trace where all this massive capital is actually flowing in the AI industry.
Right. Who's really benefiting? What are the big risks people maybe aren't talking about enough?
Exactly. And what does all this spending signal for, the global economy, tech, even politics? We've got some angles on all that today.
All right, let's get into it. Where does the money flow?
Okay, let's start with the raw numbers because they are genuinely staggering.
Yeah.
We got to grab your attention right off the bat with the biggest deals making waves.
Lay it on me. What's the headline grabber?
You absolutely have to start with that huge cloud deal.
Yeah.
Amazon Web Services, AWS, and OpenAI.
Okay.
They inked a massive $38 billion agreement. $38 billion.
Wow.
And this is all about compute power. Specifically, getting access to hundreds of thousands of NVIDIA GPUs.
$38 billion just for compute. That's mind-blowing. But hang on a sec. Doesn't OpenAI have that massive partnership with Microsoft Azure already?
Mm-hmm.
Why AWS too? Isn't that kind of redundant?
See, that's the key context people often miss. It's not really about redundancy. It's about, two things: capacity constraints and data access.
Yeah.
So first, think about where enterprise data lives. It's spread across all the big three cloud providers: Amazon, Microsoft, Google. OpenAI needs to be where the data is,
Right, it makes sense.
But second, and this is the big market signal here, even Microsoft's Azure business, which is growing super strong, like 39%, it's capacity constrained.
Meaning,
if Microsoft could just magically conjure up more data centers and get more chips right now, their growth could probably be over 40%. The demand for GPUs is just nuts. It outstrips the supply they can get. So everyone, OpenAI included, is scrambling for capacity anywhere they can find it.
And Microsoft's clearly scrambling too, right? They just made that huge Australian deal. That kind of underlines this desperation for compute power.
Exactly. Microsoft just signed a, $9.7 billion deal just to buy AI computing capacity from an Australian company, Iron.
$9.7 billion. Wow.
And that's on top of their planned $7.9 billion investment in data centers and people back home. It just proves the point. Even the giants can't build this stuff fast enough for their own needs.
So, okay, the short-term winners seem pretty obvious then. It's a digital gold rush.
Yeah.
And the first folks getting rich are the ones selling the shovels, the chip makers, the cloud providers.
The shovel sellers, exactly.
We saw NVIDIA's stock jump on this news. Some analysts are talking like $8.5 trillion market cap within a year. It's astronomical.
It is. The money's flowing straight to the companies building the digital foundation.
That's the short view.
That's the short game.
Yeah.
But here's where it gets really interesting. We have to talk about the paradox here. Is this really building a future, or is it just a massive bubble waiting to pop?
All right, bring on the skepticism. What's the financial imbalance the critics are pointing at? It sounds kind of scary.
It is jarring when you look at it. Get this. 5 major tech giants.
Yeah.
They're projected to spend, wait for it, $371 billion in 2025.
$371 billion, just in 1 year.
Just in 2025, yeah. And that's just on data centers for training and running these complex AI models. That's the investment. Now, look at the revenue side. The total revenue expected from AI tech in 2025, only about $60 billion.
Hold on. You're saying the market expects a net loss of over $311 billion in 1 year from the exact same stuff they're pouring hundreds of billions into.
Yep.
That's not a gap, that's a chasm. If the returns are that bad, why isn't everyone freaking out?
That is the multi-billion-dollar question, isn't it?
Yeah.
And look, this isn't just a blip. McKinsey thinks global data center spending will hit $5.2 trillion by 2030.
$5 trillion.
Trillion. So the critics have basically 3 main arguments. First is what they call the hamster wheel effect.
The hamster wheel of debt. Sounds ominous.
It kind of is. It's about high-speed obsolescence. These GPUs, like the latest NVIDIA H100 chip, they depreciate incredibly fast.
How fast?
Their really useful life for top-tier AI training might only be 3 to 5 years, not because they break, but because the next chip is often twice as powerful. So companies have to keep spending hundreds of billions constantly just to stay competitive. It's not like building, say, railroads that last for decades.
It is. Right. It's a recurring cost, a massive one.
Exactly. A non-negotiable expense.
Okay, what's the second big risk?
The second one is super physical, electricity. We talk digital, but the real limit might be analog.
Power.
Totally. Data centers are absolute power hogs. Electric tigers, some call them. Demand for electricity could quadruple in the next decade just for this.
Quadruple! Wow!
But here's the kicker. The physical wall. Connecting a big new data center to the existing power grid. That can take up to 8 years.
8 years? You can build the building faster than that.
Way faster. Maybe 2 years for the building.
Yeah.
But getting the power hookup takes almost a decade in some places. Physical reality, not just market height, could slam the brakes on this growth.
Okay, so you've got the hamster wheel of spending, the power bottleneck. What's the third risk?
Well, even if you solve the money and power problems, you still need applications that actually, make money.
The application gap.
Yeah, and the data there is pretty grim. Some studies show 95% of corporate AI pilot projects, they produce no measurable return. 0.
95%? Ouch.
And almost 80% of companies already using generative AI, they report no significant impact on their bottom line profits. It's like a gold rush where almost everyone's just finding dirt.
Okay, so given these huge, clear risks, the hamster wheel, the power limits, the application drought, what are the bulls clinging to? How do you justify that $311 billion net loss?
The main defense comes down to the ultimate moonshot, AGI, artificial general intelligence.
The dream of truly thinking machines.
Right. The argument is, if, and it's a big if we achieve AGI, it could unlock hundreds of trillions of dollars in global value.
Suddenly, $371 billion a year looks like pocket change.
Exactly. In that context, the current spending seems trivial. It's a bet on a paradigm shift.
And the other argument is the classic analogy, right? The 19th century railway bubble.
Precisely. That bubble burst, lots of investors lost their shirts.
Yeah.
But the infrastructure, the tracks, later the fiber optic cables laid alongside them, that stuff remained.
We got bought cheap.
Got bought cheap by new companies and fueled decades of real economic growth. The hope is, even if this AI bubble pops, all those servers will still be there, waiting for the killer app that makes sense.
Before we move off the risks, though, there's this financial engineering aspect that makes it hard to see the real picture, right?
Yeah, we absolutely have to talk about shadow debt.
Shadow debt, okay.
Companies are increasingly using these things called special purpose vehicles, SPVs, to finance these massive data center builds. Meta, for instance, raised like $29 billion this way.
So for listeners maybe not deep in finance, why is that risky? Why use an SPV instead of just borrowing directly?
Well, putting the debt into an SPV lets them legally keep it off their main company balance sheet.
Hiding a leverage.
Basically, yeah. The problem is transparency. An investor looks at Meta's main balance sheet, thinks they understand the debt load. But the real underlying debt tied to these super fast depreciating assets, it's tucked away in these off-balance sheet vehicles. It could seriously understate the true financial risk if those data centers don't pay off.
That's a huge potential blind spot for the market. Okay, so if the big tech players are facing this weird paradox, massive spending, maybe hidden risks, who's actually making money right now besides NVIDIA and the cloud giants?
Okay, yeah, we need to look at the sort of invisible winners, and the big one is energy.
The power company.
Absolutely. They're the bedrock. Electric tigers providing that essential baseload power. With demand set to potentially quadruple, these companies suddenly look like pretty solid bets.
Any specific examples?
Well, look at a company like Constellation Energy. They're a leader in nuclear power.
Nuclear, right. Reliable power.
Exactly. That steady, non-stop power needed for AI training. They're a preferred partner for giants like Microsoft, OpenAI. Then there's Vistra, another power company, seeing like 165% demand growth just from AI data centers.
And nuclear keeps coming up, especially smaller reactors now.
That's the really interesting edge. Small nuclear reactors, SMRs, like the 75-megawatt plants from Oklo. Sam Altman's invested in them.
Why small reactors?
Because you can potentially build them right next to an AI data center, off the main grid. You completely bypass that 8-year wait for a grid connection. It's like an infrastructure hack.
Smart. And we can't forget the folks literally building the grid stuff either, right? The wires and transformers.
Definitely not. Companies like Eaton, Quanta Services, the ones doing the actual grid upgrades, building substations, all that heavy electrical infrastructure, they are benefiting massively. They're riding this huge wave of modernization needed just to handle the load.
Okay, switching from infrastructure to the actual AI products, one company really stood out with strong results recently, Palantir. Seems like some AI is paying off.
Yeah, Palantir's quarterly numbers were really strong. Their earnings, their revenue, both beat what analysts expected. Revenue grew, what, 63%? Way above the 50% forecast.
And the big shift was?
The striking thing was their commercial business revenue more than doubled. It's actually expected to overtake their government contracts soon, which used to be their bread and butter. So they're proving businesses will pay for AI deployment tools.
So a genuine success story in applications. But the market reaction came with a huge caveat, didn't it?
Oh, absolutely. The success is real, but the valuation is extreme. We're talking an 85 times price-to-sales ratio.
85.
Yeah, that's sky high. It seems heavily driven by retail investor excitement, plus Palantir's own, powerful narrative about defending Western civilization.
Yeah.
They're successful, yes, but priced for absolute flawless perfection. No room for error there.
Okay, let's pull the lens back now and look at the global picture. This AI capital boom, the money's definitely not flowing evenly across the world, is it? Especially looking at Europe.
No, not at all. Europe is lagging pretty significantly behind the U.S. and China. And the data really paints a clear picture.
How clear?
Look at funding. U.S. AI funding is around $120 billion. Europe, about $12 billion. That's a 10-to-1 difference in investment.
10 times less money going in. That's huge.
It is. And that translates directly into company scale. The U.S. has over 180 AI unicorns, private companies worth over $1 billion.
In Europe.
It's just 28. And maybe even more worrying is the brain drain. Between 2020 and 2024, something like 65% of top AI PhD graduates from European universities ended up working for U.S. companies.
Wow. So the money and the top talent are heading across the Atlantic. Why? What's causing this big gap? It feels structural.
It mostly is. Two main reasons. First, regulation. Europe has a much stricter regulatory environment, GDPR, and now the big one, the AI Act.
Well, AI Act, right?
There's this saying, right? European companies have to seek approval first, then develop. Whereas U.S. and Chinese companies tend to get on the bus first, then buy the ticket.
Move fast and break things versus ask permission.
Pretty much. And the result is that for a European AI startup like France's Mistral, compliance costs can actually be as high as their research costs. It's a major drag.
So regulation, even well-intentioned, acts like a brake. What's the second reason?
Capital and market fragmentation. Europe doesn't have that single unified market like the U.S. And maybe more importantly, the venture capital culture there is just more risk-averse. European VCs tend to prefer safer bets, like steady SaaS businesses that show profit quicker. They're less inclined to back those big foundational AI models that need to burn money for 10 years before maybe hitting a massive payoff.
So less appetite for the moonshots.
Less appetite for the big long-term gamble, yeah.
And the consequences of falling behind aren't just about missing out on a few tech darlings.
No, it's much bigger. It's about future economic growth. PwC estimates U.S. GDP growth boosted by AI could be near 16% by 2030. Europe, maybe only 9%. That's a huge difference in potential wealth.
And losing influence too, presumably.
Definitely. Losing influence in setting the global standards for this transformative technology.
Although, ironically, isn't there a potential upside to Europe's strictness, kind of an anti-intuitive advantage?
There is, yeah. That strict AI Act. It can actually attract businesses in sectors where compliance is absolutely critical. Think like medical AI or high-stakes financial AI.
Where trust and regulation are paramount.
Exactly. So companies that build their tech around compliance from day one might find a niche. We see companies like Mistral AI in France doing well at their open source models, or Debel in Germany with language translation. They can leverage that compliance-first approach, especially in smaller language markets.
Interesting. Okay, before we wrap this up, we should probably touch on a couple of things happening in the U.S. policy world that are adding uncertainty to the markets, right? Just reporting impartially here, but things that affect stability.
Yeah, definitely. First, there's the ongoing federal government shutdown. It's been, 34 days now?
Right.
So beyond the immediate impact, like funds running low for SNAP food assistance, only half distributed apparently.
Which is serious in itself.
Very serious. But for the markets, the big issue is the lack of official government data. Key reports like non-farm payrolls, they're just missing.
So the market's basically flying blind on crucial economic indicators.
Pretty much. Traders, analysts, they're operating without some of their most fundamental data points, adds a lot of uncertainty.
And the other big one is a Supreme Court case about tariffs.
Yeah, there's a case challenging President Trump's use of emergency powers to levy certain tariffs. The argument is about whether the specific law used actually allows for tariffs.
And if the court rules against that authority?
It could potentially invalidate something like 60% of all current U.S. tariffs, and maybe even require the government to issue up to $100 billion in tariff refunds.
$100 billion in refunds, that would definitely make waves.
Oh, yeah. Huge potential impact on trade, government finances, everything. Another big unknown hanging over the market.
Wow. Okay, this has been a huge look at where the AI money's flowing, who's getting rich, who might be taking on scary amounts of debt.
It's a lot to digest.
Sure.
And just to be absolutely clear, as we wrap up, anything we've discussed about specific companies or numbers, it's purely for informational purposes. This is definitely not investment advice. Please do your own research.
Absolutely. Crucial disclaimer. So what's the big picture for you, the listener?
Well, the capital is pouring into the infrastructure, chips, cloud, and especially energy. But that fire hose of cash comes with massive risks. That hamster wheel of constantly needing new, expensive hardware, the real physical limits on power, and that huge gap between spending and actual revenue shown by that $311 billion projected loss.
And globally, Europe's facing a tough climb with its regulatory approach, potentially losing talent and capital.
So the final thought we want to leave you with is this. Think about that railway analogy. Is this AI capital boom laying the foundation for future prosperity, like the railways eventually did?
Or are the warning signs those high failure rates for AI projects, that fast appreciating hardware, the sheer scale of the spending versus revenue, are those signs pointing towards a true unsustainable bubble this time?
Something to ponder.
Fantastic discussion. Thanks for walking us through all that.
My pleasure.
Yeah.
And hey, if you found this helpful or interesting, please do subscribe to Sip and Talk wherever you get your podcasts.
Yeah, definitely subscribe. And also check out our old friend Mickey's YouTube channel, Mickytolife, spelled M-I-C-K-Y to life. Lots of fun stuff there. Memes, travel vlogs, good times.
Good stuff over there.
All right. Thanks, everyone, for tuning in to Sip and Talk.
We'll see you next time.